Markets are reacting to rising tensions in the Middle East. Oil prices are moving, stocks are probably going to get more volatile. But what does that actually mean for you, your investments, your job, your savings, and your long-term financial future? Today, we're going to break it down in simple terms, and more importantly, talk about what opportunities might exist in times like this. There's been rising tensions with countries like Iran and Israel, and markets do not like uncertainty. So what does that mean? Things are going to get a bit bumpy going into the future. Oil is a key global commodity, and when oil rises, transportation, goods, and production costs will always rise. When oil prices rise, it can increase inflation. When inflation rises, central banks may keep interest rates higher for longer, and when the rates stay higher, borrowing stays expensive. All of these things come into a big motion together. Now, that also means your mortgage rates will be higher, your car loans are going to be higher, credit cards are going to go up as well, and businesses are going to reduce how many people they're hiring because the cash is not cheap for them to hire more people. If we look at some investor psychology, fear is always about selling. So we want to avoid fear. Fear is going to happen no matter what. People are going to get scared. And uncertainty is going to try to make you to move to safer assets. Some short-term volatility will spike, but we already know that we don't want to do any of that. If you want to take a risk-off behavior, we should already have a setup together of your emergency fund, of part of your portfolio in areas that are risk-off, like bonds or even cash alternatives, like really short-term bonds, where that's not going to matter that much. There's also going to be some level of flight to safety. People are going to freak out, like I said, and sell their stocks and go to bonds. So bonds themselves are going to rise in price. Again, that'll be nice if you already have those, but if you don't, you should really rethink about what you're doing and know about this for the next time. Things are going to change again. History doesn't repeat itself, but it rhymes. So just remember that. And there's going to be some sort of market overreaction. And markets often move more in emotion in the short term than on fundamentals. I remember it's something that Benjamin Graham had always said, that markets are a weighing machine in the long term, but in the short term, it's a voting machine. Everybody's making the trades really quickly, but over the long term, you will see what it'll become, right? It'll trade higher in 20 years. So what does this mean to the average person? So if you're a consumer, just know gas prices are probably going to rise. Groceries are going to become more expensive, again, probably, and budget pressure is going to increase. So you're going to have to understand that your budget is going to come under fire by all the things that are going to increase with it. But there are some opportunities that you can follow. Look at tightening your budgeting habits. Maybe there's some things that, I don't need to buy this type of meat or this type of, milk or whatever it is, and trade it out for something else. Recently, I've gone into a fun thing called the human kibble, which I think is really good. And essentially what it's been for me is some rice, some split peas, and some beans. Add a little bit of vegetables. Each one of those, like the bag of beans and peas, are like $1 each. That's way cheaper than a lot of other things. And obviously you may not want to do that, but it's a big one. Another opportunity you can do is to look at building your emergency fund. If you don't already have it, build it, get on it. But if you do have your emergency fund, maybe add a little bit more, just make sure to feel it out and say, do I feel good about this? Do I see what my job is going to start doing? Do I know what I think is going to happen? And then go from there. You can also reduce your high interest debt. If you have credit cards, if you have debts and things like that, you want to reduce it. You want to give yourself as much space as you can in your budget to actually making sure that you have the ability to survive anything that goes on. As we are on this channel, if you're an investor, just know that volatility can be scary or an opportunity. One thing you always want to follow is dollar cost averaging. If you're investing consistently into retirement accounts, volatility can actually mean you're buying shares at a lower price. Volatility is up and down. It's not always down. But a big historical lesson is that wars and geopolitical events often cause short-term drops. Long-term markets tend to recover and grow. Now, if you're working or career-focused, some sectors might benefit. Energy is probably going to go up. right? The cost of everything is going to go up that way. Defense is going to do much better. Commodities in general are going to raise in prices, but other things are going to struggle, like airlines and travel and consumer discretionary, because the prices of normal items are going to go up. So what's the lesson you can learn from this? Diversify your income and increase your skills, and look at building job security during uncertain times. Do as much as you can to always prepare yourself for something to go wrong. Now, is there something you can actually gain from this? Well, when markets dip, long-term investors may accumulate assets cheaper. Again, that's the dollar cost averaging. Discipline will always beat emotion. Most wealth is built by staying invested, avoiding panic selling, and thinking long-term. And this will reveal weakness in your plan. Do you have 3 to 6 months of emergency savings? Are you overexposed to just one stock? Are you carrying a high interest debt? Global shocks do expose fragile finances, and that's a chance to strengthen them. We all may be worried about what's going on, but the only thing you can do is focus on what you control. You can't control wars or oil prices or new government policies, but you can control how much you save, your asset allocation, any skills you want to develop, risk management. Again, that kind of goes to asset allocation, and having a long-term mindset. One thing I like is this great quote: global uncertainty doesn't destroy disciplined investors. It punishes emotional ones. So to go back to it, here's some things you want to do. Review your emergency fund, check your portfolio allocation. Maybe it needs to be adjusted. Maybe you need to do a little better on that. Avoid emotional trading, continue consistent investing, and track spending if inflation rises. As this goes on, I want you to look at this as a stress test. These things are going to happen again. It's going to happen all the time. Again, history doesn't repeat, but it rhymes. It's going to happen again and again and again. Take this as a learning moment and a potential opportunity to buy things at a dip. Every generation faces geopolitical shocks. The investors and individuals who build wealth aren't the ones who avoid uncertainty. They're the ones who prepare for it. Use this moment not to panic, but to strengthen your financial future.